Hi guys, welcome back to the channel. So today I want to talk about the Fed's 4% rate cut. How is a terrible idea for America and for for not only for your money, also for the economy. Like I feel like on the surface it looks good, everyone's happy about it, but this is not gonna end well. It's not going to end well for the economy. It's not going to end well for our wallets. Okay. In late October, the Fed cut rates to 4% for the second time this year. And while a lot of people, are cheering, it sounds, it looks good. It looks like it's good news, but the reality is much more troubling. Okay. Jerome Powell, the Fed chair that he is right there, he's been under a lot of pressure from the Trump administration to basically cut rates and do all these different things. But I don't think the Fed should be pressured to make these types of decisions. All right. So the problem is, let's be straight about what's happening here. The Fed is cutting rate because they're worried about a weakening job market. I mean, that's it. That's the only reason why they're saying they're cutting rates. Okay. I mean, that part it's part real. But job growth has slowed down dramatically, right? Because the market is not, I mean, the Trump administration, everybody's saying, yeah, the market is doing great, job rate is doing great, but they're not. All right. I mean, let's take a look at this graph here. As you can see right here, let me move myself over. Right here on this side here, you can see right on this side right there, like, yes, job rate, job growth is going down. Look at the, in January 2021, that's right after the pandemic. You see this big spike over here somewhere on this side here. Yes, the job market is going down, but it's not collapsing. All right. And it doesn't necessarily warrant this type of cut that the Fed is making right now. So let's just say it's in late August, only 22,000 jobs were added. All right. Compared to about 130,000 earlier in the year. Unemployment did tick up to about 4.3%, and there are genuine signs that the hiring has stalled. But here's the thing that makes no sense. Inflation is still elevated at 3% year over year, well above the Fed's 2% target. This isn't supposed to happen at the same time, right? You're not supposed to be cutting rates while you have not met your inflation target. Okay, so why are they cutting rates right now? All right, because doing this is how you create a disaster. The inflation, the Fed is creating this inflation trap, cutting rates into rising prices. Think about what happened when you cut rates while inflation is still high. Lower rates make borrowing cheaper. So what happens when borrowing is cheaper? People go out and borrow money. When they go borrow money, they buy more things, then which drives up prices. It's like this circular logic that just basically ends badly. Like we know that if you lower rates, people are going to borrow. People are going to borrow and they're going to buy more stuff. They're going to buy more cars. They're going to travel more. They're going to spend more money. Things are going to be more higher because people can borrow more. All right. So you're going to cause inflation while you're doing that. Okay. The Fed's own projections show core inflation where they want it to hit, where they want that 2% is not going to happen until 2028. That's 3 years from now. So it looks like the Fed is 3 years ahead of schedule. By cutting rates now, they're essentially telling the market that, hey, you know what? Don't worry about it, guys. Rising prices are okay. And that's embedded into how businesses and people make decisions about money. This thing that's happening right now, what the Fed is doing is the exact same thing that happened in 1970, stagflation nightmare. The Fed kept cutting rates to stimulate employment, while ignoring stubbornly high inflation. And it created a decade of economic misery with double-digit inflation, high unemployment, and zero growth. And I think that's what happened in the 1980s. And then, a lot of economists talk about Paul Volcker. Like, we got Paul Volcker when he came in and basically raised rates about like 18% to crush inflation. Okay, the problem is once inflation expectations get locked into the system, breaking them is going to be... it's going to be nearly impossible, or you're going to have to get really brutal about it. They have to do brutal tightening later. The Fed has learned this lesson decades ago, okay? And again, they're about to relearn it again, but this time they're going to learn it the hard way, okay? Here's another thing. Tariffs. Tariffs are still feeding inflation, and rate cuts is going to make it worse, okay? But here's the critical detail. Trump's tariff policies have added about 1.3% to overall prices. According to Yale's budget lab estimates, every time the Fed cut rates, they're making imported goods relatively cheaper, like in dollar terms, right? But tariffs are making them more expensive. So the Fed cut rates to make goods cheaper, and then tariffs turn around and make them more expensive. That's basically a contradiction. That resolves itself by, basically making prices more expensive and higher prices for consumers. The Fed is essentially cutting rates to offset damage, economic damage from tariffs, while those same tariffs are pumping inflation back into the system. It's like it's so asinine, so stupid. It's like you have a cut in your left arm. While you're treating that cut on your left arm, you're stabbing yourself with you stabbing yourself with the other hand. It absolutely makes no sense. The tariff situation is so serious that economists are flagging a stagflation like risk. Slow growth combined with persistent inflation at levels not seen in 4 decades. This is exactly the wrong time to be loosening monetary policies. But also too, this tariff thing, I really don't understand what that's all about. Why? I don't know, but why are we gonna? And I made a video on this, my last video. Like, why are we tariff? Why are you putting tariff on things that we don't even make here in this country? That doesn't make any sense at all. Okay, the market labor isn't. The thing is, the Fed is taking the unemployment. I just show you guys that chart. The labor market is not collapsing. Okay, the Fed is just overreacting. Okay, but here's where the Fed's panic becomes obvious. Yes, job growth has slowed, but the labor market is not, it's not a disaster. The unemployment rate is 4.3%, and that is historically low. The broader measure that, that includes, underemployed workers and so on and so forth is the U6, and that's at 8.1%, which isn't alarming. It's not great, but it's not alarming. All right, private payroll data from ADP shows that the economy added 14,000 jobs per week in early October. Not great, but not. It collapsed neither. Weekly job claims actually fell to 219,000 in late October, suggesting employers aren't on a mass firing spree, but they're not hiring people neither. All right. So it's like, I think everyone's nervous about this tariff thing. And we're just like, just like touch and go just to see what's going on here. How far is this administration going to push this tariff thing? So I think everybody's on edge. Okay. This is just a slowdown. It's not a crisis. But the Fed is acting like, the sky is falling and they need to, start lowering rates. They're convinced themselves that cutting rates will prevent unemployment from rising. So they're doing it preemptively. The problem is that when you cut rates while inflation is still elevated and the labor market is merely, the labor market is slowing. It's not collapsing, but it's not great. You're preventing a recession. You're not preventing a recession. You're creating the conditions for stagflation. The stock market is already overvalued, and lower rates will just make it a lot more expensive. Will just blow it up even more. The Fed rate cuts, basically what it's going to do is going to suck money into the stock market. All right. Lower rates make bonds less attractive. You're not going to buy a bond if you're getting, 2%. Let's just say you buy a bond, you're getting 5% or 4%. Meanwhile, I can just put that same money in the stock market. I'm getting 11, 12%. Right. It makes sense. You're going to go into the stock market for more yield. But the valuation also, the stock valuation right now doesn't justify that chase right now. Okay. What you're going to see is that the Fed's going to cut rates, an increasingly overvalued stock market. Okay, these are the guys right here. These are the guys who are holding up the stock market right now. All right, Microsoft, Meta, Google, Nvidia, Tesla. These guys right here, these stocks, they basically represent about 35% of the SP 500. All right, that concentration alone is a red flag. All right. 7 companies is basically holding up the stock market right now. Okay. The reality that some Wall Street analysts are not telling you is that you have a bubble forming in AI stocks, elevated valuation across the board, an central bank that is now feeding liquidity into a system while inflation is still above target. The only thing preventing this from exploding is the assumption that more rate cuts are coming. Once the Fed stops or they reverse course, which they'll eventually have to do if inflation stays sticky, and this is, they can't get rid of inflation, this market is going to get hammered. Hammered. Half of these companies, or these guys right here have their stuff. It's these 7 companies are holding up the stock market right now. All right, because the only way these guys even around, the only reason why these guys are even surviving because the Fed, is giving them cheap money. The minute the Fed take that away, goodbye. These guys are gonna go. These guys are gonna go bust. Okay, or they're gonna take a massive haircut. The valuation is gonna come back to to earth, not in the stratosphere. That this is where they are currently right now. Okay. Also, the Fed is also under massive, and I mean massive, political pressure. Okay. One Fed governor dissented in favor of a deeper 50% basis point cut, while another voted against any cut at all. This committee is fractured, which in itself is a warning sign. When there's disagreement this sharp, it usually means that the decision is driven by something else and not data. There's also the fact that the Trump administration has openly criticized the Fed in the past, and he's too late. Powell, like he has this bunch of stuff, bunch of insults, a bunch of words of insults that he basically leveled at Jerome Powell. And also too, there's a governor appointed by Trump, a governor in the Fed, a Fed governor appointed by Trump who wants even deeper cuts, who's voting for deeper cuts. Okay. The central bank is supposed to be sacred. Their job is to do what's right for the economy, not what is politically convenient. Right now, it looks like the Fed is cutting rates to prevent market volatility and to keep Trump happy, not because the economic data is actually justify it. Okay. Here's the likely scenario that is going to happen. The Fed's going to keep cutting rates through 2026. Stock valuation gets even more inflated before lower rates make future earnings worth more in discounted value calculations. Meanwhile, inflation stays sticky because the Fed rate cuts aren't actually solving the tariff problems, which is causing inflation, or the supply side issues that are driving up prices. By mid to late 2026, it becomes obvious that inflation is not going anywhere, that we're stuck with this inflation. The Fed has to stop cutting and maybe even start raising rates again. So what is going to happen? Well, all these stocks, all these things, massive haircut. Okay, everything is going to crash or come back down to regular to where they should be. Okay, so all these overvalued or heavily valued stock market, they're going to get hit hard, and the correction is going to come. Okay, we're looking at it nasty. The thing is not going to be pretty, guys. It's going to be a nasty correction, just as the real economy is weakening. Okay, that's a recession with inflation, which is the worst possible outcome. Okay, here's the bottom line: the Fed 4% rate cut, like it's cut looks like it's addressing the labor market, but it's actually creating bigger problems. They're cutting rates while inflation is elevated, and tariffs are still putting upward pressure on prices. Okay, they're loosening monetary policy into overvalued stock market. They're fracturing their own credibility by bowing to political pressure. They're setting up the exact condition that created stagflation in 1970s: slow growth with persistent inflation. This isn't risk management; it's disaster management that is going to create an even bigger disaster. The only reason why markets are cheering is because they love easy money in the short term, but the bill always come due. And the way things are set up is going to be paid in years of economic pain and volatile markets. The Fed knows how to read data. What's concerning is that they know the risk and they're doing it anyway. Well, I don't know, man. That tells you everything you need to know, about where things really stand and where this economy is headed. So let me know what you guys think. That is going to be all for today. Please, if you guys find value in this video, please like, share, and subscribe to the channel. And I will see you soon.